Welcome, everybody. Welcome to tonight's session. It obviously helps if I unmute the microphone. Makes hearing me somewhat easier, I guess. Welcome, one and all. Thank you for popping in today on this slightly delayed. Just a couple of things going on today that necessitated me pushing it back half an hour. So thank you for being here. It is appreciated. As I said, always a pleasure and privilege to serve. Whether you're tuning into this on GoToWebinar or whether you're tuning into it on YouTube, either way, you're very welcome. Quick disclaimer. That was added to by the presentation disappearing just before I had to start. So anyway, let's get into things and make sure that you understand the rules of the game. Obviously, this is for educational purposes only. Please make sure you do your own due diligence on anything you see here. Make sure you manage risk, and of course, make sure that you follow trading plans and manage risk consistent with your own personal trading objectives and personal circumstances. Thank you to everybody who's already said hello. So that's really very cool. Good day to Wayne and Roger and Rob and David. Hi, Hugh. Good to see you here. Thank you, Wayne. It's good to hear that you're hearing things loud and clear. Good evening, Brian. Great to see you here as always, mate. I hope you're well. And I hope you've all had a good week so far. So what we're going to do, as always, is we're going to start by just having a little bit of a rampage around markets, and let's see what we can see. See if there's anything that we can find. A couple of very interesting price moves. Talk about some of the headlines going on as well. Good day, Johnny. I hope you're good. So here's the thing. Most traders, right, will think in terms, when they think about risk, they'll think in terms of stop loss times position sizing, essentially. And that would be your ultimate potential risk of any trading. But of course, there's more to it than that. Much more to it than that. And that'll do. That's the one I wanted. One of the key message I want to get over here is risk is not a point on the chart; it's a process, and it's a process that occurs throughout the trade. So what happens is market conditions will change during the life of the trade. Volatility will shift, and you'll get in terms of your personal trading point of view, your emotional state may shift as well. A lot of the cognitive biases kick in after you've entered the trade. A lot of the little whispers in your ears, oh, that could be it. It could be stopped, even though the market is not doing it. Even though the price action isn't telling you to get out. It just may be that your emotional state has changed where you can't bear giving back the little bit of profit you've made. So this is really the framing of this, in that we need to look broader than what you do beyond the starting risk. But that's worth just reinforcing, because we've got a pre-entry stage, if you like. So it's tracking the whole life of the trade. This is almost the embryonic phase, okay? So there's anticipated versus actual risk. So risk begins before you actually enter. If you've got any overconfidence or confirmation bias, or you're chasing late signals because you missed the initial move, this is already beginning to distort the equation. So just to give you an example of that, if we look at a chart and say, right, okay, the risk on this, on PLS, or potential on PLS is, let's say there's a potential pause point around about there. Okay, but $3. So we can't legitimately say, right, okay, the risk, if we were to do 1.5 ATR on this, probably about 15 cents below that. So probably around about this level here. Let's make that red. So when we look at risk reward, what we do is we maybe use our signal line. So the risk isn't actually this, and the reward isn't actually this, because it's already starting to move. We enter this tomorrow, and we're already behind the 8 ball a bit to where we could have been in, which was the end of or the last hour today. So what's happened is our risk has gone from being 3.5% to, if we got on tomorrow, it's 5.8%. And our opportunity has gone from potentially 9% to possibly, even if it's sort of opened at close price, to 6%. So quite a difference in what we would have been looking at or what we've been thinking about if we're looking at that at the previous candle. I hope that sort of makes some sort of sense. So when we talk about risk and this or perception of risk, then your perception of risk prior to the trade may be different and different fairly substantially when you actually get in the trade, depending on how late you are to the party. So the longer you wait, the worse your effective risk reward becomes, because there you saw it move from a risk level of 1 to 3 down to 1 to 2. So quite a significant difference. The other thing is that if we start to adhere to confirmation bias, for those of you who don't know, is when you look for things specifically that are going to back up excuse me, back up your point of view and ignore those things which may be counter to that. But there's also minimalization bias which kicks in as well. If you don't look at all of the things that are in the picture, if you don't one of the reasons why we're sort of moving down this potential concept here, I don't know why that first box isn't showing. Give me a second. So this is, let me just see. Maybe I made something false by accident. I did. Okay. So this is the new dashboard, which those of you doing the hybrid course have got access to, along with all the other scanners and stuff that we talked about before. But the idea of this dashboard is so you can see the information you need for right now. So at this stage, we've got really, in terms of your decision making, we should be looking at what economic data is coming out. We should be looking at currency strength if it's a currency. Obviously, if it's a commodity, we can do a commodity strength indicator. We've got what the commodities are doing, generally speaking, here. Holy shoot. Okay. And we've got where our we've got some risk monitor things there. Our this is critical because it's above what you would normally hope for equity. It's not critical in terms of, that's a critical risk in terms of potentially giving it back. Should we scale back, because now we're at a PL versus equity that is really quite significant. Open positions, this is caution, because there's a set thing there that says, right, 5 positions is over 5 positions is caution, over 7 positions is, so 8 positions is critical. So what we're looking to do in that hybrid group is actually putting more things here, which would mean you can reduce minimalization bias in a heartbeat. So if you have your economic calendar, you have a volatility measure of whatever you want to measure volatility on. Because for those of you I talked about volatility yesterday with the EA group, and I talked about the need to measure volatility against the asset, not the market overall. So it may be that we have a volatility of maybe 4 key asset groups in this next developed panel. And so what we're trying to do with this concept is reduce minimalization bias. So you've got all the information you need at a heartbeat, at a glance, in one hit. So you can then sort of reduce that minimization bias and ultimately pair better. Well, I've talked before at length about the benefits of being in an optimum trading state. And waiting for the right moment, being patient. Trading patience is a thing I've written an article on before, which worth having a wee look at some stage. So there's all of these things pre-entry which can alter what you anticipate your risk to be versus what your actual risk is when you get into the game. Phase 2 is what I would call entry to break even. Now remember, when you enter a trade, it's not just It's that initial few bars. It's you're already at a loss, either from a commission point of view or from a spread point of view. And it's when the trade is on its most likely to turn. We see this time and time again, where we get it's probably not a good example looking at yen crosses at the moment. Let's look at a different one. Let's look at deleted all my fates on there. Oh no, it should be there. Where is it then? Let's look at AUD USD. Drag that on. Okay, so this is a relatively good example here, where we get very excited about the fact that this looks as though it's broken through on these two candles. But if you're just looking at that as a concept on its own, then invariably it's going to potentially fall down. So this initial breakout point is the time when a trade is at most risk, is the time where it's most likely to turn around and trigger a stop, which in this case probably would be here. Markets are still not certain. There's no momentum behind the move to the upside. And in fact, the reverse could be said is the case. We've still got a cross of the MAs. We've still got, if you put a MACD on it, for example, it's not looking unhealthy if that's your bag. So we just slap a default MACD on here. So if we look at this point, we're still well over the histogram. The signal line hasn't quite crossed the histogram level. We've still got momentum that is up right up until this point here. We start to fade a little bit here, but it's a good. I really like the signal. The MACD signal line should be a barrier to entry. But if you don't have that, maybe that's something to include on a dashboard. Let me just change that to a different color. But if you're ignoring the fact that at this point in time, the signal line is now over the histogram, even though it's done this, maybe that is saying, hey, this is a reason why this is dangerous. So it's all very well me saying, oh, look, this is this part here. Whenever we get a breakout, this is the most dangerous part of the trade. Okay. You saw it here. We saw it here. We saw it here. There's a level of interest there. But you can say, hey, look at that momentum. Let's get onto this increasing trend. We saw it here. The most dangerous part of the trade is when we've initially got a setup. There's no momentum there. There's no evidence of sustained liquidity. No more than 1 or 2 bars of increased volume. Obviously, if we look at multiple confluence factors, we stack the odds in our favor, but it's really important that we don't ignore other confluence factors. It looks exactly like the one I showed you there. But look at this. That's the riskiest time. Whenever there's a breach, that's the riskiest time. It's the time when something is more likely to fail. And so what we've got is a few things going on. We've got price noise versus real directional intent. We've got people getting very excited about the move, in that there's an emotional risk personally as well, because you're part of the market participants. So you could not only enter your first trade, but enter your second trade really quickly. You can start to move stops all over the place. And we're managing risk. What we're potentially doing is micromanaging this. So we just need to potentially take a step back, give the market a chance to breathe and manage risk accordingly. So we're not automatically jumping in and increasing our risk when there's no evidence apart from the next bar has gone to the upside that we should be accumulating. I hope that makes some sort of sense. Phase 3 is floating profit. So once a trade turns green, many traders stop managing risk and start managing hope. And what I mean by that is, if you think about it, we start talking in terms of no lose trades, which is insane. Okay, so you're telling me this is the counter to that. Let's stick with this because it's actually not a bad example. So let's say we entered this short trade. Okay, we entered this short trade on a breach of this. This is trade continuation. Okay, so we've potentially got to move through that, and we get very excited. So we get in here, tick. Okay, so we can put a little tick here for when we got in. So consequently, it moves down to this place. And so what we can do is we can take our initial stop, which we may put there, and we can stick it there and say, hey, we're now in a low lose trade situation. Okay, so have we all done this? Yes or no? Does that resonate at all with you? That we start to talk in terms of no loss trades, which is a complete and utter nonsense, because ultimately your best place in the life of this trade is here. If you let it go all the way back to there, you've essentially lost 21 pips. You've given it back. So you have lost for your net worth in this position, you have lost 21 pips from there to there. So it isn't a no-lose trade. What we're trying to do is make it a reduced lose trade. So at that stage, when it had gone down again, we might move the stop to there. And rather than it being 21 pips, then it becomes 11 pips. So we've halved our risk. So what I want you to do is change, if this feels as though it's sort of some of the language that you use internally or even externally, is change your just change the narrative a little bit to my net worth in a particular position is what it is right now. Okay, if it gets any worse, then that's a loss from where I am right now. If it gets any better, that's a win from where I am right now. That's the way you've got to start to look at things, is what is price now? What is my position right now in this trade? That's the difference. That's the game changer in terms of how you perceive risk in the life of a trade. We all do it, mate. We all do it. I think of ABX. I'll come back to that at the end, on if that's all right. I don't want to. I do appreciate you asking. So, of course, there's two things going on here. We're balancing the fear of missing more, so FOMO, fear of missing out, versus the fear of giving it back. So, what we've got to have is we've got to have a risk management, a profit risk management system that adopts some sort of skill and some sort of systemized process in protecting gains without suffocating your trade. By suffocating your trade, I mean you're allowing it to breathe as it would normally do during any move. We all know that nothing moves in a straight line unless it's gold at this stage. Somewhat bizarrely. So what do? We need to make that balance. Okay, we want it. We still are interested in being in this trade, but we subsequently want it. We subsequently don't want to give everything away. So there's various things we can do. We can do partial close, of course. We can use this as a yardstick. So let's say we're in this trade, and we see this happen. And we see it get to here, and we see it pull back to there. So we think, right, okay, could we have predicted at all that that would be a stop point, that would be a pause point? Well, if we look back, well, there, you can. Why? Because that's where it paused here. So why don't you? So you've got two choices. You could partially close some there and say, right, if it breaches that, I'm going to accumulate then. But I'm going to move my stop up. Or you could say, right, I'm taking it all off. And then if we get a close through this line here, let's say at that point there, then what that says is the trend is continuing. So I'll just get back, I'll just get into another new trade. So this is the sort of thing we're thinking about when we're managing risk, managing the life of a trade. Is it time now to take some off? Is it time now to take it all off? And if we do, and to get over that fear of missing out, what would be our entry point? Do we wait till it comes back down here and bounces off that? I don't like that as a potential strategy, unless you're long-term in a position. Or unless there's a very wide range. Or do I just wait to see if it's gonna breach this and then get back in there? Or go find another opportunity. You need to stop being married to specific positions. Part of risk, part of managing risk, is knowing when it is time to have your money in something else. You're not automatic. If you're in the Aussie US, it doesn't matter whether you're in the Aussie US or not. It matters whether it's still working hard for you or not. If it's not working hard, your money's better somewhere else. So by staying in a position, crossing your fingers that there might be more in it, you may be opening yourself up to what's termed opportunity risk, if that makes sense. So this is what we need to develop, this skill of protecting gains without suffocating the trade. And that's all to do with that idea of having systems to manage that place, whilst managing this internally, or these internal demons. So it's that combination of emotional control and logic with a systemized approach to managing that. Let me give you another example. Let me just give you another example. Let's look at another asset class. So if we look at Bitcoin now, we're bouncing Bitcoin. It could be a potential opportunity. I probably wouldn't be interested in this unless it breached 122, let's say 122,800, right? So let's say we did get a breach, and let's say it did get some momentum behind it, and we're sitting here, and our stop is sitting here. Our risk in this is 0.77%. Our potential gain is 120%. So it's around about 1.5 to 1. But what happens to that if we're now at this point here? How has that risk profile changed? That risk profile has changed from, get a pen off the screen. That risk profile has changed significantly. Let's say our expected pause point is only 0.45%. Our expected stop, if we've done nothing about it, is now 1.44%. So that's more than 5 times risk to reward ratio if we do nothing about it. So we've got to do something about it, because we need to readdress that difference. But neither do we want to move our stop up to here. So next time it happens, we get a blip. Next time there's a bit of noise, we just get taken out, and it does eventually move up to there. Does that make sense? So that's all about the balance between this. Let's get rid of those that I was just talking about in the last slide. So we need to recognize when the life of a trade is hitting maturity. Every edge decays. So that was an example that I gave. The longer a trade lives, the more you're moving from probability to hope. So there's a time to gain, time decay in trade expectancy. So there's less people interested in the trade right now. And remember, more people interested in a trade, the more momentum it'll have, the more volume it'll have behind that move. As soon as that starts to wane a little bit, then of course, which is based on time around a particular price point, then you're going to get into a place whereby it's almost self-fulfilling. less people are interested, therefore it becomes less interesting. So it's recognizing, if you like, when that probability of continuation drops. And I like this phrase of graceful exits. I hope you like that. So it's the discipline of graceful exits. And again, that is a combination of being emotionally acceptable and logical, as well as having a clear, unambiguous system to be able to help you action that. So those are the phases that I would say are critical in this. So it's almost a waveform. I nearly called this the breath of the trade. But what we're trying to do is learning to sense the market rhythm in during the life of a trade, helping you to keep aligned with probability instead of making it more emotional in terms of your decision making. Now, there's all sorts of ways we can do that or add a little weight to that, is by looking at probability in practice. Probabilities is something that comes up in everything, but I could talk about probability in every slide, and possibly did actually. But maybe we need to get a little more logical. Maybe we need to look at putting some things in place which start to measure probability properly. And is that the way forward? Now, of course, we can do that in EAs. And I've just been talking, as I said, to the advanced EA group. I'll just quickly flick to a particular slide. And these are some of the things that we're looking at as potential projects. Now, these are not only potential projects for EAs, but also potential projects that inform discretionary trading as well. So things like combining filters to create a probability threshold score, or for entry, having probability-based exits. So we look at things like that changing or the reversal odds increasing as it gets near to a point where it could do that. And again, putting that in a score that says this is now the threshold. There's all sorts of machine learning, etc. The probability we can look at, there's events we can look at, but these are the risk scaling by confidence is about sort of dynamically changing your lot size, and scenario probability trees. Right. Okay. So we've had these two bars in our favor following that breakout. Is the probability of the next bar continuing in our direction 60%, 50%, or 40%? We can look back historically in terms of what it is and then make a judgment. And we can say, well, look, if it drops below 40%, if we've got an objective way of measuring it, then subsequently we get out. If it remains over 50%, we stay in. Does that sort of make sense? So there's all sorts of things we can do with this that are going to be part of the project going forward. Fantastic. That's awesome, Chris. Chris is doing a similar sort of approach to that on gold, and it will work rather well. And anybody who's in gold at the moment has jumped on. Congratulations in terms of what you've already achieved. Right. Quick flick back to the current slide. So there's a couple of things we can do. And sorry, this slide was this slide is a little bit messy. But we need to start thinking in probabilities perhaps a little more than we do. I'm not suggesting a PhD style thesis on starting to address this. There's some very simple things you can start to do. I mean, and the first is recognizing the reality of the situation. The reality of the situation is that the probability is important. That it is something worth measuring, is something worth looking at. Because trading is a sample size game, not a prediction contest. We don't know with any certainty, despite the best confluence factors and trading plan in the world, how likely or how much something is, or how likely something is to get to a particular price point. There's so many factors and ever-changing factors, as I said right at the start, that can influence that. What we need to do is try and harness those to move ourselves being in a more likely rather than less likely situation. Your job is to manage whatever trading outcome eventuates, be that something moving against you or something moving for you. I did have a probability curve, but I can't find it. I'm sorry. So that's the first thing. The second thing is probabilistic risk thinking. So don't think win-loss, think probability zones. And this is, I think, something that's really, really possible. I've already started some work on developing an indicator that does this. But let me break it down to simple terms. Okay, so if we've got a range, which we have here, I'm pretty sure that we can't say, right, if that's 50%, let's say we split it 4, actually. So let's say we've got actually 5. Okay, so we've got 5 potential zones here. Okay. So we've got zone 1, which is above this key level. We've got zone 2 here, zone 3, zone 4, zone 5. Now, what if we remember I've talked before about strength of signal as a concept? That's sort of along these lines as well. But what if we could come up with an objective way that would measure probability of it being in this place within 5 bars time? And so what we might say is that there is a 30, let me just try and get this, a 30% chance it's going to be in this range in 5 bars time. There's possibly a 5% chance it's going to be in this one here. Might be a 20% chance it's going to be here. Let's say a 20% chance it's going to be here. And 70, where are we at? 70. Let's make it a 25% chance of it being in here. Why might we score that higher even though it's lower? I'll tell you why, because of a look at all that price action that's previously in there. That's just a thing. Anyway, what we'll do is we'll come up with an arbitrary, something that's not arbitrary like I've just done there, but with something that's logical based on numerous market factors such as volatility, such as strength of signal to the upside, such as where key levels are, all of that sort of stuff. And if we can come up with this as a concept, so splitting it into zones, then all of a sudden we've got something that says, is it worth me getting out of this right now or not? Because we could also say, well, look, if it breaches this line here, the chances of it going up to here, if we get a breach here, are 45%. So as soon as we've got a system which enables us to, in some way, shape, or form, measure probability, then we're on to a winner. Does that sort of make sense as a concept? I don't think it's that hard to come up with a fairly simple model that might get that started. And of course, once you've got a fairly simple model to get that started, then you've got something to test how robust it is or otherwise. Or you come up with a market learning sort of situation which says, look, we've changed our mind. This sort of price action is no longer 60%, it's 58%. Based on the last few times it's happened, it's reduced the probability. Yeah, and the long indicator on market is very interesting. Yeah, you'd be delighted to have a chat. for sure. Let me just going to say this. Cool. Okay. So I hope that sort of makes sense in terms of the concept. I don't want this to be just something. Yeah, isn't that interesting? And we do nothing about it. Pivot points and zones, absolutely. So we could use something that's already set, and there's a pivot point calculator, obviously, that we've got for MT5. For those of you part of my out of go markets thing, but certainly pivot points are a potential. You could start to sort of say, well, look, the chances of it pivots on here instead of. I need to find it. Just in a pivot channel that didn't work. I don't like that very much. So here's my MT5 pivot scanner. Let's get rid of all the lines. Pivot ones. There we go. So we can sort of start to do this, and we can sort of start to say, right, okay, the chances of it getting here are this, probability of it getting here are this, probability of it staying in here are, that's probably about 35, 40%. Maybe 20%, maybe 7%, and so on and so forth. So we could actually use 3 lines in the sand, or we can look at swing low, swing high points, and that sort of stuff. So yeah, absolutely, Roger. So, and then what we can do is, once we've identified that, we can assign particular actions to particular thresholds. So if it's less than 40%, for example, we could avoid it, or we could start to partially close them. If it's 40 to 60%, then we don't do anything. We just watch and see. If it's 60%, then we can maybe accumulate. So what I've tried to do is introduce the concept of probability decay as time of volatility increases. Remember, I said that in the last one. The more a price stays around a particular price level, then the less likely it seems from a market point of view, unless there's some new information comes into the market, that it's going to move away from there. Does that make sense? So that's what I wanted to talk about tonight. I hope that's. So there are really 2 or 3 key messages from this. First of all, a potential change in the way you think about risk. Risk isn't just something that happens at the beginning of a trade, but happens during the whole life of a trade, and that includes a variation, a fairly significant variation on the level of risk to the level of reward, depending on how your trade goes. Second thing I really wanted to do is try and suggest that this thinking in terms of risk should actually just start from before you even place a trade, where you're thinking about a trade. So we need to look at every stage of the life cycle of a trade, and look and ask the question, well, what can we do different that might produce better outcomes? And the third message is, we need to get smarter with this. It doesn't need to necessarily be hyper smart or hyper complicated in terms of what we're doing, but we just need to make sure that we systemize not only what we do at every point within the life of the trade, but also if we start to look at probabilities in a little more detail, then we can start to put some things in place which not only help telling you when to get in and push your foot on the accelerator a little bit, but when to start reducing or even potential exiting. And of course, you can add into that all of the issues about when new market information comes in, comes into the crosshairs of what markets are thinking, and hence, of course, that means that there may be a complete recalibration very quickly. So that always becomes part of the equation, as well as what's happening And so that might be part of the probability, should be part of the probability variable. So just watch this space on that if anybody's interested. Of course, the stuff I've been doing on hybrid trading is just gets more and more interested the more and more I look at it. But certainly those of you in the advanced group, we're going to sort of look at that in some detail in terms of how we can start to integrate some of that into some of the automated trading. And of course, that may subsequently feed into the discretionary side of things as well. I hope that has given you some things to think about. Oh, okay. So let's look at this last one. Rob's asked after the AUD Kiwi spike. Okay. Would you enter a buy now as it retraced, and where to set a stop? Okay, so if we look at the pivots, I haven't taken the pivots off. Interestingly, it's starting to pause around these pivot levels. Is there any other technical landmarks that might say that this is actually a good level? And yes, there is. If we look back here, you can see that that was a resistance here and was a retracement point here when it was sort of blasting its way to the downside. So there's evidence why this should become a potential turning point. This has obviously been profit taking plus some. I don't think there's been an so what we need to see is a move through this rejected or not, and when is there evidence for this to turn upside down again? So what would price action have to do to say this is going again? And that is looking as though it might. Now, how far it might go up is obviously questionable. There could be two places it could go up to. It could go up to, if it does get some momentum, it could go up to here about 113.98. 114 is a nice round number, so that's always going to be tricky. But in terms of placing the stop, if you see a bounce that seems to have a little bit of momentum behind it, we're getting decrease in volume now, obviously, so it's not jumping up and down about a potential torpedo back up here, but it's a really good example of something that you might utilize some decision making on. But an obvious point, I can't do it on that because it's a pivot level. The obvious point would be beneath this pivot level. Space it out with maybe 1.5 ATR. So you might do, if ATR is 8, you might do 12 pips beneath that, which would be around about bearish. Does that make sense? A bit lower than that. So that might be, so take your reason for entry, a signal point. If this turns into reversal pattern, then that's where you maybe place your stop. So you want it maybe, actually 1 ATR, I would actually do on this time of day. You may do 1 ATR, make sure it's beneath that wick low. So that's what I would do with the stop, but I would wait and possibly until there appears on the 15-minute chart to be some temporary resistance around about this level here. I think if we get a breach of that, that suggests, well, look, there's profit taking going on this move to the downside. Does that make sense? Oh, chart isn't showing. Oh, sorry. Okay, so here's the put on the hourly chart to start with. I'll just quickly do that again. So here's the pivot level, and also if we look back here, there's some fairly sorry guys. There's some fairly interesting price action here and here. So that blue line corresponds to that pivot level. 2 reasons why this might be a turn point. That's what the market's doing here. With the market doing here, I'd probably put a stop, at least an ATR beneath that signal line, and make sure it's beneath that wick, and wait until we've got a breach here before you consider entry. Does that make sense in terms of a setup? So you've managed risk to the downside. It's a logical place to put it. The chances of it moving further to the downside if it breaches this are obviously increased just simply because of that price action. The chances of it to moving back up to here are probably quite reasonable because this was a pause point on the way down. So all the time you're thinking, what's the risk? What's the probability? What am I going to do at that? Because you need to know before you trade what you're going to do at this particular point. Is this the point where you trail your stop up to break even and a bit? or are you going to, and maybe you partially close on that, and maybe you accumulate some more if it comes here. That's really trading with the market breadth. Sorry about the blip on the chart thingy, but I hope that's okay. I hope that makes a chunk of sense. All good. Anyway, I hope that's been interesting, giving you some things to think about. Thank you very much for popping in today. I trust that you enjoy the rest of your evening, what's left of it. And I will catch you very, very soon. There will be a live market update lunchtime tomorrow. I'll keep your eyes peeled for that. It was a bit of a surprise we had the rate cut in New Zealand, obviously. It was expected to pause. Anyway, take care of yourselves, trade safe, and we'll catch you again very soon. Bye-bye for now. Trade safe and see you again soon. Bye-bye for now.